If you're 56 or near that age with $1.8 million saved and wondering if that's enough to retire now and spend $10,000 a month, then this video is for you. One of our clients came to us with that exact question. And despite meeting with their 401k plan advisors at their workplace and consulting multiple financial professionals, they still couldn't come to a clear answer. Today, I'll walk you through their story and show you exactly what we discovered after building a full wealth plan. If you're new to the channel, I'm Eric Rodriguez, certified financial planner and founder of WealthBuilders LLC. Over the years, I've helped hundreds of pre-retirees and retirees move from anxiety and confusion to clarity and confidence using a structured financial framework. Let's meet Jessica and Justin Johnson. They're both 56 years old and residents of California. They've done pretty well for themselves. They have $1.8 million spread across a 401k, a Roth IRA, a joint brokerage account, and a high yield savings account. Their current monthly lifestyle costs around $10,000. They had hoped to retire by 59 and a half at the latest, if not sooner, but they were stuck. They had no debt, but also no real plan. In addition to meeting with other financial professionals, they used calculators, they read retirement books, followed blogs, yet each source gave them different answers. Could they really afford to live on $10,000 a month? Or would they be forced to cut back, play it safe, change their goals? Would they have to go back to work someday? They had analysis paralysis. And this is a thing, it happens. So despite their savings, they were caught in the tension between wanting to enjoy life now and feeling they'd run out of money later. Like many, they focused on their account totals and their total net worth, but they had no strategy for income. And emotionally, what they craved wasn't just a number, it was peace of mind. You see, on paper, their plan looked solid. They had no debt. They had over $3 million net worth, 1.8 million specifically in savings, and that's more than many people dream of. But when they actually analyzed their plan, it became clear they were trying to fund a super high lifestyle retirement with a 6.7% withdrawal rate. That's a risky number, especially without a coordinated tax and investment strategy. They were missing three critical things: no tax plan to manage withdrawals efficiently, no investment bucket strategy to handle market downturns, and no framework essentially to adjust for Social Security timing, healthcare, or if they live too long. In short, they had money, but no method. And what's worse, without a distribution plan, they risked pulling too much money from taxable accounts early on, facing large tax bills and potentially needing to re-enter the workforce down the line. So there was a big emotional toll, constant stress, fear of spending, and second guessing every financial decision. Let's take a look inside the actual plan we built for Jessica and Justin using our wealth planning software, so you can see exactly how the numbers play out under different scenarios. Now, we're going to start with their base case. This is essentially if they do nothing, if they stay the course with their current plan. And if they wanted to retire at 56 and withdraw $10,000 a month, they're going to go ahead and take Social Security at age 62, which is the earliest they can take it. And they're not going to make any changes to their assets at all in terms of their location or withdrawal sequence. And they're not going to make any changes to the allocations at all. As you can see here, they're projected to run out of money around age 75. There are many culprits to this. First off is the tax drag from pulling from taxable accounts inefficiently, and no plan to minimize withdrawals in poor market years. Now, the other thing, you might hear a lot of financial planners or advisors, they might talk about it's all about withdrawals. And I talk about this a lot too on my channel. It's all about distributions and withdrawals, and you need to have a strategy around withdrawals so you can minimize taxes. But also too, there's so much more that goes into it. Even a simple thing like your portfolio and making sure that each bucket is invested properly for that specific time frame, that specific goal, and tailor it not towards your risk tolerance, but also your risk capacity. How much risk can you actually take in your portfolio? And if you're in your mid 50s, early 60s, you have to assume that you're going to live to minimum age 90, maybe even longer, right? So you need to have a plan. You need to have an investment strategy that's not so conservative or focused on income, but also capital appreciation and growth as well. Let's compare now to their base case to what we built in the most optimal way. So the first things we're going to do for this specific situation is we're going to do strategic Roth conversions between ages 56 and 72. At the same time, we're going to maintain their income in the 22% tax bracket. We will use income guardrails to slightly adjust spending in poor market years and increase spending in high-performing market years. And then we're also going to give them what we call a war chest of 5 years of expenses in cash, bonds, money markets, etc., to avoid selling in down markets. Then when it comes to their investment portfolio, we're also going to be more strategic about the midterm. So year 3 to year 10. Right? We're going to want their portfolio to be a little bit more aggressive than what they have currently. If you look at their current portfolio, they are significantly overweighted in fixed income versus equities. We need them to, as I mentioned, to be in a place where they can capture gains because they're fairly young and they are going to be in a position to be in the market for the next 30 plus years, hopefully. So we're going to get a majority of our gains, not from bonds or T-bills or CDs or anything like that. We're going to get gains from a diversified global stock portfolio. And so what we're going to do for this midterm is we're going to allocate their portfolio to a 60-40 at minimum stock to bond ratio. And then when it comes to their 10-year plus goals, we're going to leverage their Roth IRA for this. We're going to put their portfolio in a 100% global equity portfolio for the long term in their Roth account. As you can see here, if we go through the Roth conversion timeline, we can see the cumulative tax savings. Then what we're going to have them do is delay Social Security to age 70 and optimize their individual and spousal benefits. Now, let's do a quick side-by-side comparison of the base case and the optimized plan. We'll look at their success rates on their optimized plan versus their existing plan. And as you can see in their old plan, they have a very, 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 very minimal chance that they're going to be successful at their current plan. So we're able to optimize their plan at a fairly high success rate, high percentage. This is the percentage that they will not run out of money during their lifetime, and that their plan has a great success rate. And honestly, since they're over 90% here, there's an argument that they could actually spend more than $10,000 in retirement. So that's a conversation we'll have down the line. But as you can see too, we're looking at their lifetime taxes, and what this plan does essentially with the tweaks we've made is it allows them to be in a position where they're paying $348,000 less in taxes over their lifetime. They have $2.8 million in more assets with this plan. And when it comes to Social Security, if they delay and go later, they're going to have $959,000 more in income. So just by making these tweaks, we can now have a plan that is optimized for Jessica and Justin. This is the power of intentional strategic planning. You know, one plan, their old plan, leaves them stressed and cutting back. The other supports their lifestyle and increases their long-term wealth. So the real question wasn't, do we have enough? It was, when should we retire and how should we structure it? So they walked away with a clear path by committing to our retire system, by tackling risk management, by really digging deep into their expenses and income planning, by looking at tax strategy and embracing a long-term lifetime tax plan, by making better decisions with their investments and having a more efficient and smarter investment design by really structuring their retirement planning and coordinating withdrawals when they retire before 60 versus just pro rata and kind of just going with the flow, and really taking a look at their total estate and legacy planning and making sure that that is also optimized for their plan. So with this system, they moved from fear to clarity. Their lifestyle didn't have to change at all, but their strategy did. So if you're 56-ish with 1.8 million, the key isn't your balance, it's your plan. So you want to start by checking whether your current expenses align with a sustainable withdrawal strategy. A 6.7 withdrawal rate might be too high without additional support like part-time income, maybe downsizing, or delaying Social Security. Second, you have to account for the sequence of return risk. If the market drops in retirement, and there's plenty of examples of that, of people retiring in 2001, people retiring, 2007, 2008, people retiring in January of 2020. It's a thing. It happens. So we need to prep for this. So if the market drops early in your retirement and you're pulling full income from your growth accounts, then you're locking in losses. That's a huge red flag. We don't want to do that. That's when the war chest comes in. We got 5 years of expenses in safe, liquid investments that shield your portfolio from early losses. Next is the optimized tax plan. So the Roth conversions can help you smooth out your tax burden over time. It can help you reduce your required minimum distributions and can increase spendable income later. And Roth conversions, by the way, they're not for everybody, but for this specific case, it made total sense. And then don't overlook your account location, your taxable accounts, your pre-tax accounts, your tax-free accounts. We want to make sure, again, that we're intentional about how we're making distributions and where we're putting your equities and bonds in these different locations. And then also the order of withdrawals. How are we going to be making these withdrawals? Are we going to be doing taxable withdrawals first, or tax-free first, or pre-tax? It's going to be different for everybody, but we want to make sure that we're not overlooking those, because without the proper withdrawal plan, Jessica and Justin would irrationally spend over $300,000 extra in their retirement for no reason. So they're just giving Uncle Sam a tip just because there was no real planning. And also, don't underestimate the impact of Social Security optimization, because Jessica and Justin originally planned to take the benefits at 62 because they want to retire early, but they don't need to, right? They have enough in all of their different investment accounts that they can afford to delay until 70, and they can do some smart planning by coordinating their individual and spousal benefits. So just by doing that, again, they increase their lifetime income by over $959,000. So again, that's nearly $1 million added to their plan just from smarter timing. And when it comes to investments, okay, I mentioned this earlier, matching risk to time frame is essential. So their risk tolerance supported a more growth-oriented approach. So their risk score was actually 60 out of 100. So think of it as you're driving on the freeway, 100 miles an hour is super fast, going 10 miles an hour is super slow. Speed limit is somewhere around 65, 75, right? So they actually scored around the speed limit, right? 60 out of 100. But their portfolio mentioned something totally different. Their portfolio was actually at 43. So that was holding them back. That was more of an emotional thing. And it was more of a, they believe they needed to dial back their investments because they're going to be retiring. And so they had this thought, they heard from another advisor that they needed to be more conservative, and they had to go into retirement, selling off a lot of their stocks to put into more conservative fixed income assets, which obviously is the wrong move. Now, if you're just looking at investments, which a lot of advisors do, they only look at investments, then that could be a suitable recommendation at the time that they're meeting. But if you're a fiduciary and you're looking at the entire picture of a plan, we can now see that a conservative portfolio with a score of 43 is not going to cut it. It's actually going to trigger this to run out of money in their mid-70s, and we don't want that. As I mentioned before, we're a long-term investor. Even if you're in your 50s, 60s, you're a long-term investor. So you need to start thinking long-term, and your portfolio has to be congruent with that thought process. There was also 2 updates too. So when it came to their plan, we'd also have to take their workplace 401k and roll it over into an IRA and implement the more suitable portfolio, be more flexible with that, because ultimately the current 401k didn't have a lot of flexibility to match the portfolio with what they were trying to do in their plan. And again, just to reiterate, their midterm portfolio, we shifted back to 60-40 stock to bond ratio. Again, crucial to make that change. And in the Roth account, we opted to be more aggressive. So 100% global equity allocation in the Roth account. So finally, just look at your lifestyle first. So not just your savings. A $10,000 a month lifestyle is possible, but only with the right strategies in place. Having $1.8 million at 56, it puts you in a very, very strong position. But money without a plan can lead to fear and indecision. Jessica and Justin prove that with the right adjustments, even a high spending lifestyle can be sustainable. Now, if you're around 56 with similar savings and you want to know whether your nest egg can support your ideal retirement lifestyle, go ahead and click the link below. We'll send you a personalized video walking through your specific numbers using the frameworks we used for Jessica and Justin. So thanks so much for watching, and I'll see you in the next video.